everyone, and welcome back to Socially Joe. I am the host, Joe Riggio, and in this episode, we are going to meet a good friend of mine who I networked with a lot of different networking groups in here, MELLISA LILLY with Core Financial. So without further ado, I'm going to turn it over to you, MELLISA. Thank you for being part of Socially Joe, and tell us a little bit about yourself.
Hi, Joe. Thank you for having me on your show. I am MELLISA LILLY, and I am with Core Financial Home Mortgage, and we are a locally owned and operated mortgage company, and we've been in business since 2006. I am a native Floridian, been in the area over 30 years, and just happy to serve the community, finding mortgages for people and doing what's best for my borrowers.
That's awesome. I love it. So I know mortgages can be overwhelming to people at some time, and they must ask you tons of questions. So let's start it off. How does one qualify for a loan?
So qualifying for a loan, that is the most intimidating aspect of getting a mortgage, it seems, but take a deep breath and we'll take the stress away. So basically, to get a mortgage, we're going to find out a few basics about you and your financial situation. So to get the process started, we ask a lot of questions. Where do you work? What's your income, your debt, your assets, and do you have any money for down payment, or can we help you find a down payment assistance program? We explain what your options are, what loan programs are out there. And of course, we try to guide you if you don't know anything about it, or we direct you to some home buying classes so that you feel comfortable in moving forward.
Nice. I love it. Okay. So can you get a mortgage without a credit score? Because I'm sure there are maybe a lot of millennials out there that probably have not built up their credit yet.
Well, there are actually some lenders who will give you a mortgage without a credit score because sometimes people don't realize they need to establish credit, or that mortgages and loans are based on a credit score and what you've used credit for. But that would be something called manual underwriting, and it simply means that we're going to ask you for a lot more paperwork, and the loan process could take a lot longer. And there are easy ways to establish a credit score, and we can help people do that as well.
Okay. So what is the difference being called or getting a pre-qualified or a pre-approved type scenario? Because I've heard pre-approval letters and pre-qualified letters. So kind of explain a little bit more to our listeners.
So to me, pre-qualification means I've asked you some questions based such as your income and where you work and how long you've been on the job, and maybe what do you think your credit score is, and I'm going to give you a mortgage quote based on the information you provided, the borrower. But a pre-approval, we're going to ask you for specific documentations like pay stubs and bank statements, your ID, and your assets. Where are you going to get that down payment from? Maybe you have a 401k or a retirement plan that you're going to borrow from or take money out of, and you're going to prove it to us. And so a pre-approval means we are 99% sure when we submit all your information to the lender or bank, they're going to give you an approval on the loan.
All right. Well, you brought up a very interesting question. I know you said that your clients will have to provide a lot more information. Now, obviously in today's digital world and people trying to move all over from different states, they may not be in the same state to say, here, MELLISA, here's my paperwork. If you need it, they actually have to send it to you digitally. So how secure is this for clients of yours to know that their information is not going to be stolen?
So that is a good question, and it can be scary in our techie world. But we do have secure applications that once you complete the application, it's going to ask, are you ready to upload documents? And they are secure with extra firewalls. And we assure our clients that their information will not be stolen. partner with certain lenders. They're all A-paper lenders, meaning they have the financial background to have some of the best securities in place in the nation.
Nice. I love it. So, Melissa, the big question on everyone's mind is, how much of a home can I afford?
That is the big question. That is for sure. That's like one of the most searched for things on the internet when you're getting a mortgage. How much can I afford? So buying too much of a house can certainly start you off on the wrong foot when you're a first-time home buyer. And a real estate agent should, of course, guide you, but get pre-approved first to see what you can afford. So I know that some people recommend a 25% or less of your monthly income is matched up to your debt, but there are mortgage guidelines, FHA right now, 50% at certain lenders of your monthly income would be all of your debt, including that new mortgage, but some of them will go up to 56, maybe even 57%. And then for conventional, the norm is 43% of your income is a mortgage and all of your monthly debt. And that's like credit cards or car payment, or maybe you have a student loan. A lot of people have student loans. So 43%, but they will go up to 50% usually around 49% for conventional loans. So we never want to put someone in a house that cannot afford it, because then they're just headed for trouble, and they're gonna have a bad taste in their mouth, and they're gonna be like, oh, that mortgage person didn't warn me about this. So we always try to do what's best for the client.
That's great, because we don't want to have like another 2008 again.
No, we do not.
So how much should I save for a down payment if I want to put down on a home?
So, I mean, there are so many different loan programs out there for buyers. There's Home Ready, Home One, Home Possible, which are conventional loans. So you can start out there's some that offer a 1% loan up to a 20% down loan. And then FHA, which is the Federal Housing Authority Administration, they 3.5% down. So, I mean, there's just different programs. It's going to be what fits into your budget and your needs, and that is where we advise what loan program is best for them.
Okay, I love that. So how do you know which home mortgage option is right for me? Because I know you said there's different mortgage programs out there, but how do I know which is right for me?
Well, we are going to look at your income and your budget and, of course, your debt to income ratios, and then we're going to advise you on what program. So I know that lenders are getting back to offering that adjustable rate mortgage. I don't recommend it, and I really don't write that business. But FHA loans for first-time home buyers, that seems to be one of the biggest loan programs for those type of buyers. And then you have VA loans, which is zero down for veterans and active duty, and then veterans that are out of the military. And, of course, fixed rate conventional loans. So fixed rate is where I like to write business, because I don't want somebody to be surprised every year when their mortgage goes up. I want it to stay level for them and affordable.
Nice. I love that. So how does my credit score affect my mortgage and buying any property? It doesn't matter.
Well, credit score is one of your most important records that you'll ever have. It affects the pricing of your mortgage, interest rates. So right now we have historically low interest rates, and credit score can affect whether you get a 2.99 rate or you get a 2.25 rate. And there are costs to those rates. And most of the time, me and my team like to do loans at par, which means no cost to the buyer. So we always try to review your credit report with you, make sure you know what could cost you money, and even try to advise how we're going to improve someone's credit, because you don't want to leave money on the table when you are buying a mortgage, or that same mortgage can cost you more when you have a low credit score than that person right next to you that has a high credit score.
Well, what happens if I, before the mortgage is actually set down at the closing table, what if I go out and buy a car?
Oh my goodness. If you go out and buy a car, that's going to affect your credit score, because you're going to have more debt, and that can affect your debt to income. So it could be right before closing, you go out and buy a car, and you won't qualify for the loan any longer. So do not, once you're in a mortgage, you're moving towards closing on that mortgage, we give you little helpful hints along the way about what you should and shouldn't do. You shouldn't open any new debt or do anything that is going to affect your score.
That's great advice, because I was looking at that Lambo.
I hope you get it. I'll need a ride.
Okay, you got a deal. We'll go to the VA club.
Yes. Yes.
Anyway, how does one lock in their rate?
Well, mortgage rates change daily and sometimes every few hours. So locking in your rate guarantees you a certain interest rate for a specific, period of time, between 30 and 60 days. But we do have lenders that even go longer than that, because it seems like we get contracts that are getting longer and longer in time periods. So in most cases, once we register your loan and we have the conditional approval, we will lock the rate. Sometimes when we register the loan and we know we're going to get that approval, we go ahead and lock the rate. That way, if we see the forecasting that we check every day, a couple times a day, if it says the rates are going to go up, we want to keep you at that lower rate. So we go ahead and lock it.
So let me ask you this. What happens if a day passes and I forgot to get you some paperwork and I had to wait the next day, and then you had to lock me in a different day for a rate? Will the rate still be the same as what you quoted me the day before?
It could be, but it could change. Like I said, it changes every day, and we check it every morning, and then sometimes we will get notices throughout the day that pricing on rates have changed. So if you don't have all your paperwork in and we are not able to lock the loan for you, then it could be that it costs you more money, or it could be that something's happened where the rates get a little bit better and it was good that we didn't lock you, and now you're getting a better deal.
This is true. It never fails.
Yeah, you never know.
So, Melissa, I always have to ask this question, and I'm sure my listeners would probably have the same thing on their mind, but what are mortgage points? What is the point about them?
So mortgage points are a way to buy down or prepay for interest to get a lower interest rate on your mortgage. Each mortgage point is 1%. So on a $250,000 loan, if you wanted to buy down the rate by a point, it would cost you $2,500 up front to reduce your interest rate, sometimes by 1/8 to 1/4%. So sometimes it is advantageous to do that, and other times it's not. It just, we have to calculate what the upfront cost is and how many months it will take you to recoup your money. And sometimes it's with the rates as low as they are right now, sometimes it's just not even advantageous to do that.
Well, my next part of that question was, I know you said upfront money would have to pay for per point type of scenario, but is there a limitation of how many points you can actually buy? Or is it just like, oh, well, you have X amount of funds and you can just throw it towards it until you want to buy it?
Well,